S&P is lower in the final hour of trade while the Dow Jones is sitting right on the fence. We had a rosy report for the US housing market today and several retailers reported solid results. Now we're joined by Mark Newton of Grey Wolf Execution. Mark, why has bearish sentiment appeared to win out today?
Well, I think the markets gradually started to stall out. I mean, we had a pretty decent move. We recouped about 5% in the last few weeks. We've gotten back all of January's losses. Now we're right back near former highs. Everybody's talking about the market breaking out to new highs, but it's really just a select handful of indices that are doing that. The NASDAQ moved up, but the S&P and the Russell really have stalled. The Dow, which still has about a 90% correlation to the S&P, is still a few hundred points below its highs that it hit back in January. So I wouldn't necessarily say it's bearish sentiment. I just think the markets have moved up a bit too far too quickly, and now with a lack of catalyst, you're starting to see some gradual emerging market weakness over the last couple of days, particularly within the currencies that might have people a little bit on edge.
Okay. Now we had some good results from some of the retailers today. Are you positive on the outlook for either consumer discretionary or consumer staple stocks this year?
The discretionary in particular, just because retailers have been under substantial pressure from November to January, are now slowly but surely starting to bottom out and rally. So that is a good sign for discretionary. This group had been a real laggard in January, one of the worst performing, and now you're definitely seeing signs of retailing picking up. So despite this cold weather not being over by a long shot here in the Northeast, I think that these stocks have been under a bit of pressure, and now they're starting to bounce. But I'm not sure how long-lasting this rally in this group will be, but for now it still looks to move higher in the retailers.
Okay, and finally there's a bit of chatter about volatility with expectations that it's likely to pick up this year. Do you share that view?
I do, very much so. There have been a number of problems technically with the market over the last month or two that are a concern. The only thing that's held up really is price, but there have been far fewer stocks hitting new high territory. That's a concern. The volume and the breadth of this recent bounce since February has been anemic, to say the most. I mean, there's been very little sign of any true strong recovery. Financials, if anything, over the last week are starting to hit new low territory in relative terms. So that's important because financials comprise the largest percentage of the market. When financials aren't working, the market shouldn't be working. So it's encouraging to see discretionary bounce, but when financials can't participate and there are fewer stocks hitting new highs, it's definitely a warning sign. I would look out probably second or third quarter and thinking that after April, the market probably has a decent chance of turning down and selling off 10 to 15% between April and September, October. It's tough to really make too much of it, though, until we see the price break. But for now, that's what I'm calling. I think the year will be flat to slightly down, and I think the initial pullback will be one to buy dips in.
Okay, thank you, Mark. That was Mark Newton from Grey Wolf Execution, and I'm Searle for TheStreet.